In this video, I will help you to understand how mutual fund returns are calculated. This would be an important video because majority of the people have no idea how mutual fund returns work. So first thing you have to understand is that mutual fund returns are based on NAV movement. NAV is net asset value of the fund that changes every single day based on the changes in the portfolio. For example, equity mutual funds would have stocks in the portfolio that would change every single second. But NAV of a mutual fund would update at the end of the trading session. If I take you an example, if the NAV of a mutual fund is 100 and suppose you invested 5,000 rupees, then the units would be 5,000 divided by 100, that is 50 units. Now NAV would vary every single day based on the movement of the underlying stocks, bonds, golds, etc. And let's say after 1 month the NAV of the mutual fund becomes 110 rupees. Then your profit would be 50 units into 110, that is 5,500. That's a profit of 500 rupees. Or you can say 10%. Since the NAV would vary every single day, your return would also vary every single day. What if you invested 5,000 when the NAV was 200 and after 1 month the NAV becomes 180? Since you invested 5,000 when the NAV was 200, then the calculation would be 5,000 divided by 200, that is 25 units. And if after 1 month the NAV becomes 180 and you want to exit from that mutual fund, then the calculation would be 25 units into 180, that is 4,500, which is a loss of 500 or 10%. Now let's do the calculation in Google Sheet. I will take a straightforward example that would help you guys to understand how mutual fund returns are calculated. If you want me to create a real world example, please comment down. If I get enough traction, I will create one. Before going, I request you guys to subscribe as it helps the channel to grow. Now, I will take two cases here. First, lump sum investment and second, SIP investment. So let's first start with lump sum investment. So as we discussed, when you invest your money, you should know the NAV of the mutual fund at that point in time. Let's suppose you have invested in XYZ mutual fund and the NAV of that mutual fund at that point is 50. So every mutual fund has got NAV in rupees and this NAV keeps on changing every single day. Suppose the NAV of the mutual fund that point in time is 50 and you invested 3 lakh rupees. Right. So what will be the total number of units? The total number of units would be total amount invested divided by NAV. So if I do the calculation, it is 3 lakh divided by 50, which is 6,000 units. So let's say after 1 month, the NAV of that particular mutual fund becomes 60. So what would be your total value of investment? The total value of investment would be the units into current NAV. So if I do the calculation, it would be 60 into 6,000, that is 3,60,000. So what would be your profit or loss? The profit or loss would be equal to the value of investment minus the invested amount. So it is 60,000 rupees. This is as simple as that. So what we have done, we have taken the current NAV and we have used that NAV with the amount of units which we have bought when we took the mutual fund, and we have done the calculation. Let's suppose after 1 or 2 days the NAV of the mutual fund becomes 51. Suppose you have taken a mutual fund, the next day the NAV becomes 51. So what will be your profit or loss? So you are gaining 6,000 rupees. In another example, suppose you have taken a mutual fund when the NAV was 50 and after 1 month the market went down and the NAV became 48. So what will be your profit or loss? So you are in a loss of 12,000 rupees. This is as simple as that. So this is not a realized loss or profit. At the end of the day, when you sell your mutual fund, that particular time, whatever is your NAV, that is your realized profit. So these all are unrealized loss or profit. Let's say after 2 years, the NAV becomes 80. And if you want to sell your mutual fund, that particular time, the calculation would be 6,000 rupees into 80, which is 4,80,000 rupees. That would be the profit of rupees 1,80,000. So as your NAV moves, your return would be changed. I hope now you understand how the returns are calculated in lump sum investment. So please note that in equity mutual fund, when you do a lump sum investment, the return would be very volatile due to market fluctuation. And if you want to do lump sum investment in equity mutual fund, you should know the market situation. Watch closely and understand whether the market is overvalued or undervalued. Suppose right now, when I am shooting this video on 18th February 2023, the market is consolidating from past couple of months. And it is a good time to do lump sum investment in equity mutual funds. When it comes to debt mutual fund, when you do lump sum, it invests in fixed income instruments such as corporate and government bonds, which are less risky. So in debt mutual fund, there is no problem in making a lump sum. But in equity mutual fund, the investment in lump sum is quite tricky. Because let's say when you did lump sum investment in equity mutual fund, the market was at peak and the NAV at that point in time, let's say, was 200 rupees. You invested 3 lakh rupees and you got 1500 units. After some time, the market corrected and the NAV dropped to 100. Then in that case, you would have a loss of 1,50,000 rupees. Hence, that is the reason it is essential to do SIP investment irrespective of the market situation. Now we would go to the second case, which is SIP investment, and I will show you how the return is calculated in SIP. So let's say you are doing an SIP investment for 6 months. For simplicity, let's start that in the month of January, the NAV of that mutual fund is 50. In the February month, it is 52. In the March month, it could be 49. Let's say in April month, it is 48. And the next month, it is 55. And the last month, it is, let's say it is 60. Right? So now you are investing 5,000 rupees per month. Right? As it is same for all the month. Let's do the same till here. Now we have to calculate the units. So we know how to calculate the units now. So it would be 5,000 divided by 50. Right? So if I click on this, I get the exact total number of units for all the 6 months. So the first month it is 100, next month 96, some other day it is 102, 104, 90 and 83. Now suppose after some time the NAV changes and the latest NAV is 65 rupees suppose. So what will be the total units purchased? The total units would be a sum of all these. So let's do the calculation. It would be sum of all these units. So it is 576.603 units. So what is the total investment amount? The total investment amount is equal to sum of these 6 months, which is 30,000 rupees. So what is the value of investment? The value of investment is nothing. It's just the latest NAV into total units purchased. So the calculation is total units into the latest NAV. So which is 479 rupees. So what is the profit and loss? The profit and loss is equal to value of investment minus the total invested. So the profit is 7,479 rupees. It is as simple as that. So you are able to understand how in SIP we can calculate the NAV and the loss and profit. With SIP, you have the chance to invest during different market cycles. Investors do not have to watch the market movement as closely as they do for lump sum investments. So this was a non-practical example just to simplify things. As I mentioned earlier, you can comment down if you want me to cover a real-world example. You can also mention the exact mutual fund name which you want me to cover as an example to calculate the return. With this, we have come to the end of this video. I hope you would have liked the content and this would have made sense to you. If yes, please hit the like button and subscribe to the channel. Thank you.